Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I want to welcome back a gentleman that really understands what's going on in the mid-market in Canada, the United States, from a M&A standpoint, a mergers and acquisition standpoint. His name is Mark Borkowski. He is the president of Mercantile Mergers and Acquisitions Corp. And what he tells me is that the market has changed dramatically, and there's now, for the first time in his career, a lot of people selling and not as many people buying. And so therefore, this is potentially a great buying opportunity for all of us that want to get into entrepreneurship, buying businesses. Mark, welcome to the show, and tell us what's going on.
Thank you, Brian. For 35 years in the M&A business, 5-10 times a day, I would preach, I would say, there's an incredible amount of money, incredible number of buyers for a very limited number of sellers. Now in this post-COVID period, we're overwhelmed with companies owned for 40, 50 years by company owners who are exiting. Our North American trends may say the big deals have slowed down, but suddenly we're seeing a flurry of lower and mid-market company sellers coming to market.
And
we haven't seen that. We haven't seen that in my 35-year career.
And are the buyers still there?
The buyers are here in droves, but they're not taking advantage of some of these opportunities. Let me give you an example. I mean, this is a little bit shocking. Companies in the hospitality industry, the restaurant industry, are prepared to walk away from their companies for $1. As long as somebody will take over their debt, you can have their business.
Right.
I mean, for those individuals who have a little bit of guts, a little bit of capital that are looking to enter the market, I don't think there's ever been a better time. And I've never said that.
Now, what's
not
causing
in my
this?
career?
Is this interest rates that's causing this?
Interest rates, the post-COVID kind of fallout, general malaise. As you talk to these owners and you say, well, why are you not continuing? You've weathered the storm during COVID. Why are you not continuing on to the next phase? And they'll tell you, many have said, we don't have confidence in the future. We think we're entering into a long-term recession. Time to get out.
Really?
Yes.
So people are worried about a long-term recession.
Yes. We're hearing that from private business owners, that they don't anticipate a 1 year or a 2 year downturn. These are people talking about 3 and 4 years out. These are smart people who've run businesses for 30, 40, 50 years.
And they're willing to sell their businesses for a song.
At the moment, yes. I mean, we're seeing valuations and talking to people that we may have talked to 2, 3, 4, 5 years ago who'd given us outlandish expectations. Suddenly now they've all come back to reality. So we're seeing quite a number of lower and mid-market companies coming to market that we wouldn't expect.
So I interviewed a fairly smart venture capitalist who said that what's going to happen in the private market is going to be a couple months behind what happens in the private market. And public markets were down by 30, 40% back I guess in the spring in June.
Yes.
And is this just sort of the private markets catching up to where the public markets already were?
I think so. And the venture investments in North America have slowed down dramatically. And those trends are being documented. I don't work in the venture capital market, but I can tell you that we are overwhelmed on a monthly basis, hearing inquiries from companies seeking venture capital.
Really? That
market is in trouble. However, the private company sale market is changed dramatically. Again, 35 years, I have never seen anything like this. So we're on a daily basis, we're getting inquiries from people we wouldn't expect to be hearing from.
And the IPO market, from what I understand, is almost closed down. It's down like 90, 95%.
Exactly. I don't think we've had this kind of a downturn in 28 years. I mean, all these big institutions, the banks, are all letting investment bankers go. Their fees, the bank's fees, and all these big, IPO investor groups make money on the big fees made in IPOs. This was the worst year for IPOs in 28 years.
Really?
So it's a tough time.
If you can't go public and you can't, which is sort of the next stage, and markets were down, but they're back up, I guess, now.
Yes.
And if you can't get venture capital money, I guess you got to sell, which is what you're finding.
Absolutely. I mean, one of the options, of course, was if you were of a proper size where you earned at least $2 million of EBITDA profit, earnings before interest, taxes, and call it depreciation or amortization, the private equity community were there in force. They have slowed down because their institutions are no longer investing in private equity firms. Last year, something like 32% of all institutional private equity firms in the US gave their money back to the institutions because they couldn't find deals. However, there are many still very active scouring the market, and they're seeing some good deals. On average, on an average sale mandate for a company of that size or larger, we would probably have, without exaggerating, between 50 and maybe 100 qualified buyers that would come to the table requesting a non-disclosure document, requesting, a confidential information memorandum. Suddenly now, for whatever reason, that has kind of slowed down, and we're seeing more deals, available opportunities that weren't there 2 years ago, 3 years ago, and we're seeing more.
But at the
Not
same
sure
time,
why.
At the same time, I read article in the paper today say private debt markets are down dramatically as well. So if you can't get the money from the bank and you can't get the money from a private debt market, where are you going to get the cash if you want to buy?
Private investors. They're still out there. There's still private investors that are high net worth individuals. They're now being approached. I mean, I'm reaching out to people I haven't talked to now in years saying, are you interested in acquiring another opportunity to your family office, to your portfolio?
Really, that's interesting. So that the public markets went down and are back up to a certain extent.
Head fake.
IPOs.
David Rosenberg called it a head fake this week, that this is just a temporary blip, 1,200 rise in the Dow.
It's a head flip.
A head fake.
What do they call that? A dead cat bounce or something like that.
Something along those lines.
And so this is interesting. This is fascinating because it's really going to lead us to an interesting situation for guys like you, that you're going to be pretty busy getting a whole bunch of people potentially into new businesses.
Absolutely.
And, I think that's a really interesting story. And at the same time, there's going to be a whole generation of people that have been growing their businesses for 20, 30, 40 years that are going to be struggling to get the net worth out that they thought they would already always planned that they'd be able to get out. It's sort of similar to the, people talk about the housing market. So there's some interesting parallels there. We're going to take a break for some messages and come back in just 2 minutes with Mark Borkowski, who is president of Mercantile Mergers and Acquisitions, talking about the current state of the M&A business in the mid-market that he says is the most imbalance, with more sellers and less buyers than he's ever seen in his 30-year career. Fascinating. Stay with us, everyone. We'll be back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Mark Borkowski. He is the president of Mercantile Mergers and Acquisitions. Mark, you've been in the M&A business for what you said, 30 years?
35.
35 years. And you were on our show, I think a year ago, and you said that there was an incredible amount of private equity money and other money chasing few deals, and valuations were at, I thought you said, an all-time high.
Copy. High valuations. And
this has all changed.
It's scaled back. I mean, suddenly when you have a limited number of investors and buyers in the market looking for companies, and there's more availability of companies available, valuations tend to level off. And we've seen in the last, call it 5-6 months, expectations diminished of company sellers because they've been talking to people saying, we're not prepared to pay the high values that you might have asked a year or 2 or 3 ago.
Give me a sense, if you could, of an industry sector, what would have been the EBITDA multiple a year ago and where you think the EBITDA multiple is today. And explain as well, if you could, what an EBITDA multiple is to everybody.
All right. So an EBITDA multiple, earnings before interest, taxes, depreciation, amortization.
So it's effectively the pre-tax cash flow that you get from an opportunity.
That's correct.
Okay.
So for companies that would be earning, say, $2 to $3 million of EBITDA profit, they would have seen valuations north of 5 times. So if you were selling your business and you were earning, let's say, $2 million, you could have expected to see a purchase value between 10 and maybe as high as $12 million. That's dropped off. We've seen probably multiples now closer to 4 to 4.2, 4.5 times. So that's a significant drop
So
in terms of value.
a 20% decline in EBITDA multiple, 5 to
Correct.
4.
Absolutely correct. And that's across the board. It hasn't applied to some of the industries. There are industries where this is never going to apply. At the moment, probably the hottest opportunities are in insurance brokerages.
Really?
I mean, the valuations are outrageous. So contemplating doing anything in that market, you're competing with the big companies, the big insurance companies are searching directly. But everything else below that.
Okay, so give me a sense. What would an insurance brokerage firm go for as an EBITDA multiple?
They trade on multiples of revenue, and it's as high as 3 times the revenue. And it's almost impossible to get a return unless there's some kind of significant synergy by another broker or another insurance company that can, benefit from those synergies. So when you're looking at 3 times the revenue and you're trying to work that backward, no individual could acquire a brokerage and make it work. However, the strategics can do it.
As you know, because we interacted at the time I used to be in the beer business, and beer companies would be trading at 7-8 times EBITDA.
Correct.
So above your 5. What would a microbrewery or a beer company go for? Any idea what a consumer products company
I mean, there's been lots of documentation this past couple of weeks, also in the Globe and Mail, that industry, the craft beer industry, is consolidating rapidly. Today, there are people looking out to buy some of these small craft companies for 3.5 times EBITDA.
3.5?
No joke. 3.5 times.
When I was saying it would be 7 to 8.
That's history. Some of these groups now have taken on a substantial amount of debt. There are, I believe, 163 craft brewers in Ontario, something in that range. I mean, they're all not selling beer. They've taken on a lot of debt. Many are looking to exit, and they have to exit. The banks have become very vigilant now with all customers.
Yeah.
We're seeing a big change.
So tell me what's happening with banks, because that's interesting too. So,
well, interest rates have gone up. Interest rates have gone up, and as a result of that, we have felt because the banks have traditionally lent on leverage buyouts. You could have borrowed probably up to 3 times the cash flow in debt to acquire a business. That's scaled down to probably now 2 times. So the banks have really pulled back from doing these leverage buyouts.
Right.
On average, we've seen a lot of these very highly levered transactions 2 to 3 years down the road. 50% of them would fail or be resold again for a variety of different reasons. The banks have realized that. So the banks now are not backing a lot of these acquisitions. So they've backed off.
They're going from 3 times debt down to 2 times debt.
And less.
And so effectively, if you're saying that the companies were trading at 5 times and they're now trading at 4 times, effectively the equity check is the same. What has led to the depreciation in the values is 100% the reduction in bank debt.
Absolutely. I mean, the vast majority of all transactions are made with bank debt, of some kind of debt. I mean, who's going to use equity? If you can borrow from one of the traditional banks, in single digits, you're going to try to load the opportunity up with some cheap financing.
Now,
and that's been bank debt.
Interest rates have gone up. Everyone knows that. They haven't gone up as much in the long term as they have in the short term. Is that correct?
Correct. But still forecast to go up.
It's interesting as I saw some of these, and some people didn't realize this, but as you saw these sort of 50, 75 basis point increases in the bank rate, the short term, the long rates were going up by like 10 and 20, right?
Correct. So I mean, the banks are backing off. Obviously, less capital available.
Yeah.
So sellers who are anxious to sell have fewer buyers.
Now,
and there's more of these opportunities. People are recognizing they can't sell their businesses at the lofty values they were expecting 2 years ago.
Now, I've also heard that credit spreads have increased. Can you explain what a credit spread is? And tell me, has that stayed the same or has increased?
I think that's relatively still stable at the moment.
Oh, really?
For the most part.
Okay,
but that's going to catch up. That's going to change as well, more than likely in the short term.
What is a credit spread?
Credit spread is spreading credit out over a number of different call it facilities. So some people will take on debt in different forms and spread it out over a different number of investors or platforms.
Right. So it's interesting. I think that, what I hear, Mark, is that the interest rates are up.
Yes.
The amount that you're paying above the sort of the benchmark interest rate is up, and the amount of debt that you can get is less than it was before.
Correct.
And that even when you're paying more for that debt and there's less of it available, there's this flight to quality, flight to far better security. And so therefore, while you might be able to get the debt, you're jumping through a lot more hoops if you're not the highest quality borrower.
Correct.
Looking for personal guarantees and corporate guarantees and protections and security that are far more than they may have asked for before. And so for a small entrepreneur, a small business owner, it's more challenging to roll over your debt or get new debt today. Is that correct?
Absolutely. So we've seen a lot of these transactions take place where owners pledged very little of their own equity. They could have financed a lot of these transactions with bank debt. If they could have borrowed a 2.5 to maybe 3 times cash flow, they would have had a vendor, the seller, take a vendor take back note and maybe even incorporate some kind of an earnout. The banks, what we're dealing with, Bank of Montreal, RBC, Scotia especially, are basically saying, look, we're not prepared to lend on a very highly levered basis. Mr. Buyer, you now have to pledge more of your own equity. Show us a bigger check.
Right.
However, we're seeing more sellers than I think we've ever seen across the board in all markets. And we've seen a very disproportionate of opportunities in the hospitality restaurant industry. As I say, you can buy certain properties for $1 just by assuming the debt. So,
well, you and I talked about this during the pandemic, and
yes.
I had some friends owning local restaurants that were increasing their debt by $100,000 a month.
Yes.
Because they tried to keep their employees on staff. The province shut them down with mask mandates, etc. They were helped a little bit in the summertime when people opened up patios on parking lots and laneways, and they made a lot of money for a while in the summertime. But that was come and go based on whether the weather was good. And then some of these surprising close downs where you got 24 to 48 hours before a close down. They ended up having a lot of food that went bad because they couldn't, they had ordered it and they had it in their fridges and freezers and they couldn't sell it. So I think a lot of restaurateurs in the pandemic added into debt. Even if they survived, they added to debt. Even with the money they got from the federal government and some forgiveness they got from landlords, they added to debt. And if you thought as an owner, and we didn't know the pandemic was coming. But if you thought as an owner, a recession's coming and it's going to get just as challenging all over again, I can understand you might want out.
They're exiting, and they recognize that, and you're absolutely correct. There are some large, call it hospitality business that have taken on an incredible amount of debt. And I've looked at some of the financial statements in the last few weeks, and it's astounding. These companies that had great value 2, 3, 4 years ago are virtually worth nothing at the moment. And owners, because they've personally guaranteed this additional debt that they took on during COVID, the $100,000 a month that you talk about, $1 million of more debt a year just to keep things going. Now suddenly they're recognizing there's no out and that they've got personal guarantees at stake. And the banks now, very rarely are we going to see a deal without there being some kind of corporate assurance or personal guarantee on this debt.
Okay, so turn it around then. Is that a buying opportunity or would you stay away?
It's a buying opportunity. We're seeing valuations dropping. We're seeing people who are now recognizing that this is a long road ahead. And the biggest factor that we determine in all of these businesses, people can't find employees across the board. Talk to any business owner. The common theme will be we can't find qualified people. In the construction industry, it's awful. So I spoke with an owner of a construction company who employs a little over 200 people. Previously, very profitable company. He now interviews with a small mirror. He takes a mirror, and after the interview, he holds the mirror to the person's breath, and if it fogs up, they're hired. It's that bad.
If they're alive, they're hired.
If they're alive and they're breathing, take But on your
Okay.
construction,
Well, let's talk about this for a second, Mark, because I think that has been the situation, no question. Unemployment was at an all-time low,
yes,
and trying to get people, particularly when they could get CERB and other kinds of government money, they stayed home. But now I'm reading report day after day about tech companies laying off huge amounts of people and other people laying off huge amounts of people. Accounting firms and law firms and consulting firms laying off people. You already mentioned investment banks that are laying off people.
yes.
So is this all about to change? And, going into a recession, it should change. Unemployment should go up, and there should be a lot more people available.
Yes, but we're not seeing it right now. So owners who are in some kind of distress, whose banks have leaned on them and said, you're pretty close to breaching your covenants. You either better put more money back in or come up with another solution, or we're going to ask you to take your business elsewhere. And that's going on right now. We're seeing the banks talk to owners, and we're receiving these calls from people saying, hey, TD Bank called us after 3-4 meetings and said, we think you're going to have to take your business elsewhere. And they'd been with the TD Bank for 27 years.
Well, it's interesting because I think that a lot of the banks were probably told, cautioned, advised, whatever, by the federal government, central banks during the pandemic to go easy on clients. And I heard story after story of people that they thought they would be go into default or breach covenants and did breach covenants, but ended up having cooperative bankers during the pandemic. But that now that kind of nice attitude, that second chance at things, now that the pandemic is over, and what we found is that sort of that very lenient attitude in everywhere, whether it be central bank, whether it be fiscal policy, whether it be whatever, has led to runaway inflation. That people's attitudes are changing, and banks are getting a little bit tougher.
Both bets are off. During COVID, we were told, and I've been, obviously we deal with all the major banks, that all the major bank senior executives, bank presidents were summoned to Ottawa to meet with the federal government. And the federal government said, hey, we know we're in a tough time. This is post-COVID. Go easy. We know there's been, big companies that have breached their covenants. Go easy on them. Work with them. Work through them. Well, the banks have been working with them now post-COVID for 6, 7, 8 months. We're hearing that the banks in the new year are going to start enforcing their security, which means they're going to pull the pin. There's a publication that comes out, which is free, by the way, called Insolvency Insider. It's published by a former MNP accountant by the name of Henry Lewis. You can subscribe to it, Insolvency Insider. Well, it goes for pages now of all these large organizations, mid-sized organizations, smaller organizations that have been put into insolvency. We're seeing this as a major trend going forward. Lots of insolvency and more deals. Companies that probably shouldn't have been put into insolvency, but the banks can't hold on forever. Yeah. Banks are not investors. Banks are lenders. Banks lend against security. So what do you expect? We're seeing a trend going forward now of a lot of disaster, in my opinion.
But at the same time, Mark, I think what you're suggesting, which is something that I've talked about for a long period of time, is that those sort of overall market challenges or disasters, the way you call it, lead to some good buying opportunities. And
absolutely,
more people have made sort of, generational net worth value in tough times than almost any other time. Because when markets are spectacular and it's easy to get money and valuations are going up, it's too expensive. And it's now it's when you're a contrarian, when you can hunt around and find those interesting buying opportunities. And you go through story after story of rich families in the history of the last 100 years. They made their money by making big bets, consolidating industries, buying companies during tough times.
Absolutely correct.
And so I think what you're saying is, for smart people, for smart money, for people that have got access to cash and or have got some friends that can help them out, or high net worth investors that can help them out, now's the time to look.
This is an incredible time for people who are hoping to enter the market. In my business, we only have two motivating factors. We have companies company owners that are greedy, and companies now that are fearful, company owners that are fearful. Fear and greed. We went through a period of people who are very greedy and looking for 7, 8, all kinds of multiples above the norm, and no solution. Today, these people are fearful. And when you speak to them honestly, privately, many of these business owners tell you that they don't have a lot of confidence going into this recession and that there's going to be changes. And they've taken on a lot of debt. And they have obligations they have to pay back to the government. Yeah. Many took loans, the COVID loans. Now, it's Judgment Day. So, solution is sell your business. You didn't want to sell it 2-3 years ago. You're now 74 years of age, Mr. Company Owner. What are your options? Sell the business, except probably less. However, the number of buyers have not woken up yet that these opportunities are available. Then the purpose of this interview today is to let the community know that there are some incredible opportunities of very prestigious long-term businesses that were very profitable, that today probably are not as profitable or close to, but have taken on more debt. Okay, and that's fearful.
Why don't we take a break and come back and ask you if you were interested in buying one of these companies that you're talking about? What's sort of the process that you'd go through to do the due diligence, to find the right company, to have the right advisors, to get the right amount of debt, and to make sure that you're making the right bid? Stay with us, everyone. Fascinating conversation about the mid-market mergers and acquisition business that Mark Borkowski, president of Mercantile Mergers and Acquisitions, is saying has, for the first time in his 35-year career, really switched such that there's a lot more sellers and fewer buyers, and the sellers are selling at cheaper, lower valuations. And so therefore, if you wanted to own that restaurant, or you wanted to own that automotive company or whatever it is, now might be the time for you to think about doing it. You got to be tough. You got to be rigorous in your analysis. You got to be stringent in your negotiations. But now might be a golden opportunity for you to get into that business that you always wanted to get into. Interesting opportunity, Mark. We're going to be back in 2 with Mark Borkowski. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga Night 60. Mark Borkowski, he was the president of Mercantile Mergers and Acquisitions, a company here in Toronto that specializes in advising companies in the mid-market that are selling themselves, and for buyers that are interested in buying those companies, is our guest tonight. And it's an interesting proposition that he's laying out, which is, I think, it's sort of intuitively similar to the real estate market. To sort of put forward my proposition on the real estate and Mark's proposition on sort of the mid-market is that public company values have come down, and the private company values and the real estate values sort of follow. And we've all known these statistics in the home private residence market, where volumes are down something like 46%, but prices are only down 10, maybe 15% if you get into the burbs around the GTA. But most people think that because of the volume decline, the prices haven't come down because the sellers just haven't, come to the reality that they're not going to be able to sell at the old prices. But once they readjust their prices, and I'm getting emails on a, once an hour basis about new price, better price, etc., they will come down. And ultimately prices will be down to around what the volume is down. And I guess what, Mark, you're saying is that it's sort of the same, which intuitively makes sense. If public market values have come down, and we know they have, down, 35% up until this bounce this last little while, but down 35% in public stock market between December of last year and sort of the spring, summer of this year. Logically, the private market value should come down by a comparable amount. And they haven't up until recently. And now you're saying that volume is down, volume of purchases is down dramatically. And there's a lot of sellers out there. And it just makes sense as well from if you knew a recession was coming and you didn't want to have to go through that recession and add on debt again, as you did in the pandemic, I'd want to get out now. If I've got some money left over and the value of my business, enjoy it in my retirement. And so that sort of makes intuitive sense. Now it's probably, it's too late. I should have got out a year ago or 6 months ago, but getting out now is right. So if those two propositions are right. And I've talked to real estate people, and you've commented on some of the shows in the real estate market. And so therefore, if your proposition is right, that now's the time for people to think about looking for value opportunities. And, Mark, there's lots of people that have always dreamt of owning their own business, and they've built up a little bit of a nest egg, and they've got some capital, and, putting it in the stock market today isn't great. And Bitcoin is a disaster. And so buying a company is a dream that a lot of people have always had.
Absolutely.
So talk me through, you and your experience must have, done deals in almost every industry sector. If you were a dentist, a lawyer, a businessman, a whatever that had, a couple $100,000 or $1 million, and you wanted to invest in a company, give me a sense of some of the different companies that you can invest in, what the multiples would be, what the prospects would be, and how you would go about the process of looking for those companies and then potentially buying them.
Well, let's start with your last point. How do we find those deals?
Okay.
Company sellers rarely tell the general public that they're for sale. That's a rarity. You don't hear of somebody publicly stating that their company is for sale. We advise them never to do that. So the receptors of these deals are people in our business, the mergers and acquisitions professionals, the lawyers, the accountants that hear about these confidential opportunities. Buyers need to reach out to people like us to learn about these opportunities. So it starts there. So anyone who's interested in doing this will generally reach out to a professional in our business. And there's quite a number of people that practice. The banks are in the business. The Bank of Montreal have a mergers and acquisitions group. RBC have a mid-market mergers and acquisitions group. And we all were receptors of lots of buyers in the past. And we would sort of turn them away and say, thank you. We're putting you in our database. Now we're very happy to hear from these buyers because our sellers are really sellers now. And they're sellers for another reason. They're sellers because during COVID, most companies had big drops in revenue and big drops in EBITDA. They're starting to come out of that right now. Many of these sellers are coming to the realization that they're not going to get 2019 values. During 2020 and 2021, with revenues dropping, yes, we can go back to them and say, yes, we can get you the value at the highest peak, but now you're going to have to take something called an earnout. If you think the company's going to come back to its level of 2019 in 2023 or 2024, that as opposed to giving you a lot of cash up front, we're going to give you some kind of a vendor take-back note and a chunk of the proceeds in an earnout. And an earnout means if we get it, you get it, we get it. If not, that's it. So earnouts have come back in force. Really? Companies are now having to take the idea of an earnout. But company owners who have no other option are saying, look, I have to stick around now longer because, as long as they're there, you've got a better sense that an earnout can be realized. However, we're dealing with people who just seem not to have confidence going forward. Entrepreneurs are very intuitive people, and so I'm an entrepreneur, and you sense among these people that there's a very cynical outlook going forward. In the lower and mid-market, there's just a lot of negativity looking into 2023 and 2024.
Okay, so
it might be the fact that they've talked to their banks. Banks are tightening. Where you may have borrowed $1 million from the bank has come back and said, you had a rough year in 2021, 2022. Tell you what, we can now only lend you $700,000. So we've scaled back, and that's going on. So that's putting a crimp on a lot of these opportunities.
So let's say that somebody always wanted to own a retail store. I don't know what it is, whether it's just a Dollarama type store or a dress store or something or other store, retail store. And you or some accountant or somebody knew it was available. How would you go about looking at that opportunity and investigating it and making a bid on it?
Well, from my standpoint, obviously we do the analysis up front. And so we'll be introduced to an opportunity either by a referral from a lawyer, an accountant, a banker, or another entrepreneur who says, I've got a colleague owns 7 retail stores in ladies wear, and they're spread out all across Ontario. So now we've met with this owner, and the first thing we do, no cost, no obligation, is we do evaluation. and we'll sit with them for, I think we talked about this in a previous show, it probably takes about 4 hours to do kind of a high level valuation. So we'll go through something we call a normalization of income. So we'll look at the balance sheet, we'll look at the income statement, and we'll normalize what the real earnings are. Remember, private company owners have a lot of benefits. They take vacations, they bring spouses on trips, they have entertainment, meals, extra cell phones, extra cars. So we do a real normalization of what the real earnings before interest, taxes, and amortization is. So we bring it down to a real number, and then we apply a multiple. And if we're on the same wavelength, we ask for a mandate. We carry on. If not, many of these people say, well, that's not the value I'm looking for today. I did 25% better in 2019, but I want to sell because I'm just not looking forward and going into this very difficult market. So we say the only option is, if you are really a seller, you're going to have to take some portion of the proceeds in an if-come type of structure, an earnout.
Right.
However, in the past, earnouts were very unpopular. People would not discuss earnouts. Today, they are becoming the norm. So buyers coming into the market with much less cash, providing that they've got some bank support or other investor support, can acquire these businesses substantially better. Your point about some of the greatest families making great fortunes and building net worth in tough times is true. People have acquired businesses during very difficult times, and that's going on right now. We're seeing industry consolidators in virtually every market.
Really?
Yesterday, I spoke to somebody who's acquired and hoping to acquire 7 to 10 companies in the door and window industry in the next year because they're available. And so you say, well, my God, where he says we're getting calls directly from companies. So companies in business are getting calls from competitors, from logical companies down the street, down the block, who are in the same businesses, reaching out to other companies. So there's opportunities. We haven't seen these opportunities before,
now,
not to this level.
One of the ways that you can effectively reduce the purchase price, or at least for a while, is this earnout that you mentioned.
Yes.
And pay on the if come, as you mentioned. What about vendor take back financing? Is that available, and what is it?
Well, a vendor take back note is basically saying to the owner, okay, so your purchase price is, pick a number, $5 million. We're going to give you $3 million up front, because that's required. You stated that. But now we're going to ask you for a vendor take back, like a mortgage. We're going to ask you to take this note back, a seller's note. So we're going to give you $3 million up front. We're going to ask you to take $1 million vendor take back note at an interest rate usually a lot less than what the banks offer. And that note is not secured. That note is second to the bank borrowing.
Right.
So if the business goes bankrupt and you're next in line with a vendor take back note, you don't see it. On an earnout, it means, well, okay, we had a great year. We made profit. So there's 3 ways to do an earnout. And the simplest way, of course, is we share profit at the bottom. That's not a good way. There's been many, many disasters with that, because companies who have acquired the business can load the company up with a ton of expenses. So there is no bottom line. The second approach is, well, we share a portion of what's called the gross margin. So we take a portion of the gross margin. The problem with that approach is that there's a lot of reporting, a lot of financial sort of study to get to that number. The easiest earnout is we basically say, okay, we're going to give you a royalty on revenue. You don't have to worry about what we're doing with your company. We're operating it in our proper way. So if your revenues jumped from $6 million in revenue to $7 million in revenue, then we will pay you a royalty, a percentage of the revenue on the top. And that's what's very common right now. And it's palatable to owners to say, look, I believe it's going to come back. Well, if you believe it's going to come back and it's going to exceed what you did, well, then you be prepared to take an earnout. If not, carry on.
Okay, so ways of structuring a deal are including an earnout, where
Yes.
you pay in the future some of the purchase price based on performance, whether it be performance of revenue or gross margin or EBITDA.
Correct.
Another way would be to have a vendor take back note or a loan, such that the vendor doesn't get paid 100% of the purchase price day one, but takes a certain amount of the purchase price over time, and you pay back that loan over time with some sort of an interest rate. Are there other things that one would structure into a deal when you're purchasing a company?
Well, I mean, it can be even more specific. You can offer them something, referred to as pref shares, giving them pref shares that they get some benefit from the upside. The other, and this has almost now become very common, buyers are asking owners to keep 20% of the company, to stay involved, to ensure that there's going to be some kind of continuity. Remember, when an owner leaves, a lot of these businesses are based on the owner. He's the business in many cases. The business can have 300, 400 employees. Without the owner, things change. So what we've seen from the private equity firms, the family offices, individual buyers are saying, look, we want you to stay in. So instead of us buying 100% of the company, we will buy 80% of the company. You'll stay involved with us as a consultant, maybe as an employee, and together we're going to grow this business. And at some point in the future, we will buy the remaining 20%. Well, with the right partners in the past, when we've done these deals 5, 6, 10 years ago, where owners agreed to stay around, what we've seen traditionally, 8 out of 10, 4 out of 5 times, that 20% in 4 to 5 years was worth more than the money they took up front from the purchase price, because they grew the business together with a smart owner. So today it's still common. Buyers are asking owners to stay involved, to share the risk, because there's risk going forward.
I got to tell you, one of the best, most profitable deals I was ever involved in, and this isn't a small business, it was a big business, but I worked for the Molson companies. We owned Aikenhead's Home Improvement Warehouse, which was a copy effectively of Home Depot or Lowe's or Rona or something like that in Canada. And we did that because we owned Beaver Lumber Company, and we saw these big home improvement warehouses coming to Canada. So we launched Aikenhead's Home Improvement Warehouse. We had 6 Aikenheads across the country, and we had potential leases for, maybe a dozen more and that we had rolled out. Home Depot Canada wanted to buy us out, and we were making good money and didn't want that. So we ended up selling 75% of Aikenhead's Home Improvement Warehouse to Home Depot Canada, which got them established in the marketplace far quicker, because they had 6 stores that they quickly changed from Aikenhead's to Home Depot, and then a whole bunch more leases, and they could expand far more quickly than anyone anyone else. And just this past week, as you probably noticed, Lowe's pulled out of the Canadian marketplace. So coming in second is sometimes is a bad strategy. But we kept 25%, and we kept that 25% for 5 years. That 25%, 5 years later, was worth 2 times what the 75% was worth.
Okay, I rest my case. You're correct. Lowe's and Rona were sold this past week to Sycamore Partners out of New York. Sycamore own about 12 or 13 major platforms, including Staples, the U.S. operation of Staples. I mean, Sycamore Partners is a private equity firm are going to come in and just cut, slash, burn, and get rid of a lot of these stores. And remember, the Rona network is made up of a lot of independent hardware stores. These people are running for cover and looking for other relationships not to have to buy from these parent companies. The transaction that Sycamore done, of course, is confidential, but if you have friends in the private equity business, they've told us that a lot of the purchase value was based on if we fix it, we can make it work, and we can return back to the glory days of hardware, you'll share the upside. And the Lowe's family, the Lowe's group, basically accepted that deal. More to come. There's more deals like this coming.
More deals. And it's interesting, because the numbers that I saw were that they had bought, Lowe's had bought the Canadian operation and Rona and other things for a couple $2 billion, and they sold it for less than $500 million.
Yes,
so
a fraction.
A big loss on sale. It's a fascinating market, and I think we're going to see this in real estate. I think we're going to see this in venture capital, and you're certainly seeing it in the mid-market business, and that's kind of interesting. We're going to take a break and come back, and I'm going to ask Mark. I'm going to try to play the contradictory person, and ask Mark, maybe we should all just run for cover, and why He does not think that's the right strategy. Stay with us, everyone. We're going to come back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. I'm chatting tonight with Mark Borkowski, and he's putting forward a really interesting proposition that I think should be interesting to a lot of us out there that have always wanted to own a business. And I think a lot of people, in Canada, around the world, would love to be a small or mid-sized entrepreneur and own a business. And what Mark is saying is that in his 35 years in the M&A business, he's president of Mercantile Mergers and Acquisitions, a company in Toronto that advises buyers and sellers in the merger business in the mid-market segment. He says in his 35 years in business, he's never seen such an imbalance between buyers and sellers, such that usually it's a lot more buyers, and that has bid prices up. But now it's more sellers. And to a certain extent, it's probably predicated on increasing debt during the pandemic and getting a little bit tired of business during the pandemic. But now it's concerned with the coming recession, and that people are trying to sort of sell out prior to a recessionary time period. And what the proposition that Mark's putting forward is that now, because values are down, might be the time that you might want to go out and buy a company. Mark, let me just play the contrarian for a second here and say, you know what?
Go ahead.
We don't know how long this recession is going to be. We don't know how high interest rates are going to go. Every single time interest rates have gone up in the past to stem inflation, they've had to have gone up higher than the inflation before the inflation's come down. And we're still, with interest rates where they are, inflation at 8-9%, we're still half of what the interest rates got to go to if they're going to actually do what's done in the past, which is go higher than inflation to stem that inflationary tide. And, there's so many people that just, have never lived in an inflationary environment before. We haven't had inflation like this in 40 years.
Correct.
And we're also in a different kind of a scenario where governments don't have the fiscal gunpowder because they've spent so much money, increased debt and deficits to such a degree during the pandemic for probably good reason. And central banks have kept, interest rates low and have done quantitative easing and other things because of the worries of the pandemic, that a lot of the things that you would typically have had governments and central banks do to get us out of a recession, we don't have the latitude to do that today. So maybe this is going to be a pretty bad recession, and maybe it's right to sell businesses, and maybe it's right to be a little bit nervous today and not buy. What do you say to that?
It is an incredible time at the moment from what we can see. I mean, we spend, as I've said, in the high times, we would have 100 interested parties for some of these mid-market businesses. And we didn't see these opportunities. We're seeing more of them now. And so when you see more of these opportunities, buyers have more opportunity, to make proposals to these opportunities. So, I mean, we can't explain it. It's very difficult to explain because in 35 years, as I said, I preached 5 to 10 times a day to everybody that called and say, lots and lots of money, nothing to buy. Sorry, call another day. Well, suddenly now I'm reaching out to buyers and saying, hey, we've heard about this opportunity that we're putting a sim together for. Are you interested? So it's really changed, and it's going to continue to change. Understand that as the banks have tightened, Brian, and they've clamped down. So if I borrowed $1 million and now the bank says you can only borrow $700,000 and your interest rates have gone up, many companies, I would say 65 to 70% of all companies operate with bank facilities. They operate with the bank. A lot of companies operate with their own cash. They have, they made profit. They don't bother with the bank. But if your interest rates have gone up and the bank have clamped down and said, we're not going to lend you the $1 million, we're going to lend you $700,000, suddenly now these owners are operating in different circumstances. So what are their choices? Carry on or contemplate a sale. Contemplating a sale at the moment means you're probably going to see a lower value, unfortunately. However, there are exceptions. There are businesses that are still going to continue, with the high multiples like insurance brokerages. But we're seeing a trend we have not seen in my career in 35 years. Lots of sellers. Let's buy a business, Brian. Let's buy a few. What would you like to buy?
If you want to buy, what do? Do you go on your website to register for a newsletter?
We don't. Again, for confidentiality purposes, we don't have any kind of list to say this is what we're currently divesting. You've got to speak with professionals in our business, and we have to understand what your criteria is, and we have to understand whether you, the buyer, have do, re, mi. That's what we qualify. If you've qualified, we're happy to open our kimono and say, here's what we're working on.
So if someone's interested, Mark, what should they do? Check you out
Call
on
me.
LinkedIn or what?
Call me, call me through contact me through LinkedIn, through my website, through my email address, phone me, contact my colleagues. We're all working on more projects than we have in the past. Good time to be a buyer.
And what's your website, by the way?
www.mercantilemergersacquisitions.com.
Mark,
you can find me on LinkedIn. If you're on LinkedIn, you can find me.
Mark Borkowski, thank you so much for joining us. I really appreciate it. Let me finish with my 2 cents, if I could. I do think, as Mark and I have talked about, is that tough times are the times that that people can make really good buys and create wonderful companies. And one of the reasons why is that so many other people run to the sidelines because of all the fearful reasons why it might be justifiable to run to the sidelines. And so therefore, there are fewer buyers out there, and there are a lot of sellers, and the imbalance is there. And so therefore, the buying opportunity exists. And if you go back in time, whether it's the Brofmans with their alcohol business, or JP Morgan, or, we could go through the list of different companies. Warren Buffett got his start during tough economic times. So buying when everyone else is selling, being a contrarian, is actually a really good strategy. Now, you got to make sure you make a good buy. You got to make sure you do your due diligence. You got to make sure that you're not over-levered in tough times if interest rates are going up. But I do think that this is a time for the strong to get moving, for the brave to get moving. And so therefore, if you've always wanted to own a business, if you've always wanted to be an entrepreneur, if you've always wanted to go out on your own, now might be the time you can do so, and do it at relatively inexpensive price, at least to what you would have had to pay a couple years ago. So Mark Borkowski, I really appreciate you joining us. Thanks so much.
Thank you, Brian. Thank you for having me.
That's our show tonight, everyone. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online, even from downtown Toronto, Mark, at www.saga960am.ca. Good night, everybody.
Thank you, Brian.